0xPxls on Twitter, the founder of Tau Labs. And I think we've picked a pretty interesting day for this podcast because yesterday there has been quite a bit of controversy about various vault providers that are acting in a gray box fashion, so where you do not have total transparency into what they are doing. So yeah, I think there's a lot to discuss, and the space overall keeps growing and flourishing. So yeah, I think Tau Labs is a pretty interesting player in that whole stack. And thanks for joining us, Vlad. How are you doing?
GM, thanks for having me over, Max. I'm doing very well. It really is a very interesting day to do a podcast, and yeah, we can definitely get into the whole, rehypothecated TVL discussion. We actually have some strong views on that, and I'll give you a bit of insight from behind the scenes on the discussions that we had internally when we started doing vaults. Like, okay, how do we announce these? How do we market them? Do we use TVL? And yeah, we have some interesting solutions there.
Yeah, I hope it will get a little spicy down the road. But maybe let's start by giving our audience a little bit of your background and how Tau Labs came about, and yeah, how you developed to the space you're in right now.
Sure. So, quite a bunch of people that listen to you are from the dojo. Uh, I've been in the dojo for many years, since I think since Steven launched it. So him and I go back quite a bit. I lurk there a lot more than I talk. I've been starting to be a bit more active recently, but for the people that don't know us, Tau Labs was started a couple of years ago, 2 years ago, initially as a tokenomics firm. So we were simply designing tokenomics and incentives for a variety of protocols. Historically, half to two-thirds of our clients have always tended to be DeFi protocols, so borrow lending protocols, perp dexes, etc. And the rest have been a variety of L1s, games, uh, data pipelines wanting to tokenize, RWAs, etc. As the company kept growing, so did vaults, and we were paying a lot of attention. We had quite a couple of projects that were looking into it, and it's with more markets, who's now live on mainnet and off Flow blockchain. They needed to, yeah, they were starting to build infrastructure for vaults. And kudos here to Patrick, the founder of More Markets. He's the one that actively implanted the idea in my head that, hey, do you guys want to curate a vault? I thought about it previously, but only in a passing thought because we had quite a lot of work coming from the tokenomics area. And we decided, yeah, okay, let's go. So starting at the beginning of this year of 2025, we actually started to put pen to paper and see, okay, what vault do we design? Let's look at what others are doing. How does Mev approach vault curation? How does Gauntlet approach it, etc. And we ended up not launching our first vault on More. We ended up launching our first vault on iPort. That was in April. And here we are today. I think five or six vaults later across iPort and More markets. In the spirit of the conversation that we're also going to have, Tau Labs today has a total of $9 million in deposits. So that is what you could call AUM, which notionally, with the rehypothecation that we use, would push up to $70 million. So it depends if you want to call us a 70 million TVL fund or a 9 million AUM fund. I am fine with either. Um, we've had the simple philosophy to just be transparent with our strategies and just do them permissionlessly. And the vault side of the business started growing more and more. Um, However you look at it, 9 million in 6 months or 70 million TVL in 6 months, the growth is still really, really good, especially compared to other curators that were our size back then or still are kind of our size now. And the tokenomics part and all of the knowledge that we had to like design incentives, design points, model them, we just simply absorbed it into basically risk management. So now we work mostly with stablecoin projects, with RWAs, and of course we do vaults. We are working more and more with LPs and with hedge funds who want to have managed strategies on chain. That is kind of the top-down view of where we were and where we are now.
Maybe.
And for those that don't know, this is another little hi to the dojo. 0x Roger is our lead strategist, and yeah, he's been with us for, I think it's cool. I think it's been a year. I think it's been a year this month since he's been with us. So you see him moderating and being opinionated all the time in the dojo. Just so you know, I always say like this is my quant, like in The Big Short.
Yeah. Maybe to circle back to your origins a little bit, I remember last year the whole tokenomics discussion was much more present on crypto Twitter, and it faded into the background over the last, let's say, 12 months. But to me, it doesn't seem like there has been a one size fits all solution or like some monumental progress being made in that field. Last year, I worked with a company and we tried to apply better tokenomics design specifically on airdrop campaigns to filter out who to reward and what actions to reward. And back then everybody was talking about it, but it just completely faded into the background. And it seems like the market and our industry has accepted that there is no proper solution to that. So it's a little bit of a side quest conversation, but what is your view on that? Do you think that we have actually solved the persistent issues in tokenomics that have also contributed to the altcoin underperformance of the last 2 to 3 years, or do you think that any meaningful progress has been made?
So we have a fundamental thesis at Tao that I talk about everywhere I go. A lot of tokenomics firms and a lot of people use the word sustainable when they talk about economic models or tokenomic models. We refute that. We don't agree that we don't agree that there is such a thing as a sustainable economic model. A consistent one, yes. You can have an economic model that lasts for a very long time. The stupidest example I give when I talk to people that are outside of crypto are like we used horses as main transportation for tens of thousands of years until within the space of like 10 years we just stopped and we just went into cars. It's kind of the same here. There is no solution one size fits all. You can be more creative than others, and you can find different ways of trading time for capital and for commitment slash loyalty from users. That's where you kind of play in tokenomics. Now, crypto is a great area to play around with more experimental economic models because it's open, it's transparent, it's immutable. You can check everything. Um, so I don't see it as there being any solution to solve. I mean, it's the efficient market hypothesis. People will always try and get a leg up on a different person on a different project. Some projects are more PVE, others are more PvP. You can't really create a one size tokenomic model that works for everybody any more in any way that you can create only one style of heart surgery, for example. You might have the fundamentals for how to, I don't know, do a bypass, but every person's heart is different and every surgeon is different. So they will be applied differently. And also on this point, a lot of people approach this saying is from our lawyer in Romania. The expression sounds much better in Romanian than it does in English, but it's we say it's better you come to us as you do to an architect and not to a firefighter. We've had many projects contact us like, can you fix our tokenomics? And you had like 99% of the tokens emission was out. 70% was in three wallets, and we tell them like, guys, there's nothing we can do here at this point. Just launch a V2, launch a new one. Try not to dump on whatever retail is left. So these things should be designed earlier. But yeah, it changed. The space changed. It's a lot more mature. It's a lot more DeFi and more finance focused now than it was before. And retail is out. A lot of retail is out, got shaken out, and a lot more institutions are coming in. So there's less need to have these custom tokenomic models again and again. But we'll see. We'll see. Some of them maybe are going to come back. Some of them are going to be more popularized. I have hot takes. Like, for example, I do legitimately believe, I think Steven has kind of the same idea. Uh, Olympus DAO, the idea was not bad. The core idea of rebasing at its fundamental was not bad and is not bad today. It's just the execution was not ideal and the timing was maybe off, but the core idea was legit, and we see it now um, used in a lot of stable coins bringing yield on chain. So the core idea is there.
Yeah, I think the whole tokenomics discussion, it will likely take a back seat and kind of just get I mean, nobody wants to talk about it until we have proper legal frameworks in place that give people actual rights to the underlying equity. I think then it inevitably will come up again in some sort of fashion. But yeah, I think the purely on-chain native discussion about what are right tokenomics and airdrop structuring, it has sort of been given up by the industry. But yeah, to continue on the vault side of things, so the Vault ecosystem as a whole has seen a huge rise this year. When I was at Denver, I first noticed that everybody's kind of interested in Vault infrastructure. And before Denver, at least on a personal level, all the DeFi farming I did was completely manual. Like I never really deposited into any vault. I knew the concept being around still from the old sommelier finance days, which I saw launch at Cosmoverse 2022 in Medellin, which was like quite an yeah, obscure setting because it was basically launching and built on Cosmos, but the vaults were on EVM, and then you had, I think it was Seven Seas and later Veda that were active on Sommelier. And I think
Yeah,
Steven, he was involved in the
yeah,
very early iterations of vaults in DeFi. But
yeah.
yeah,
And a good chunk of the sommelier team, I think they are Romanian, so they're fellow compatriots. There's something about
oh,
Romania
interesting.
doing math with vaults, apparently. The national
So it's
sport.
like you know the meme with the people pulling the strings, so all the vaults in DeFi are
It's all
coordinated by
Romania.
Romanians. Hmm.
It always has been. This is the grand conspiracy. Crypto DeFi is really just like six Romanians just puppet playing everybody.
Yeah, that's a good new addition to the large list of crypto conspiracies. But yeah, we've seen the space grow tremendously this year. Could you give our audience a rundown of who these different stakeholders are? Because from a user's, even from a power user's perspective, I think for many it still looks
Yeah.
very confusing who's actually around and how these people differ from another. Like, I mean, of course, you can sort of differentiate between an automating rebalancing like lending aggregator. I think some of the Gauntlet or Superform vaults are doing that. But within all the vault infrastructure providers, let's say like Upshift or like IPOR, and then you have all of the people on the curator side, you have the big actors like MAV Capital, RE7, you guys. Who's doing what, and how can we think about the different tasks, responsibilities, and roles of these actors?
So DeFi became very modular, and there is a lot of competition in giving out yields, and there are many different ways to give out yields. Effectively, this is at least the way we talk about it internally. What you do in any strategy and what you do generally in finance is, you know, how you have the crypto trilemma. There is a thing, there is a similar there is an alternative to this in finance where you have sort of a financial trilemma where you manage between time, risk, and capital, and you will always move somewhere inside this triangle. Now, people who have a lot of money, they don't need to take a lot of risk because 5% a year on $1 billion is 5% is a lot of money. But the lower your capital is, the more you ideally should take on more risk. Otherwise, you will just grow by, I don't know, $10 a month, and that won't really take you anywhere. And you can always offer different risk parameters to different people. So the assets, stable coins, yield bearing, over collateralized, different protocols that offer these. These are the things that you use. These are the actual Lego pieces that you put together. Now, moving a step up, you have the place that allows you to put these Lego pieces together. This is where you have infrastructure. This is where you have Veda. This is where you have IPOR. You have more markets, Concrete, Upshift. You mentioned Lagoon Finance. All of these guys, right? They're all different in their own ways. Some of them use safes. Uh, yeah, some of them use safe architecture, which allows you to also vote on whenever a change happens in a vault. Others use more diamond architecture, like IPOR, for example, or more markets, where they just connect to a bunch of protocols and they just grow from there, like a spider web. Veda is a bit more monolithic, but their tech is also really, really solid. And these are the places where you go to connect to Morpho, to Borrowland, or maybe to some dexes, to Swap, or to all of these places. And then you have the curators, and this is where I want to mention again one of our theses when we launched. When we wanted to become vault curators, the discussion was also if we want to do infrastructure, and we decided against it because our thesis, it still is. Maybe it's not as true as it was back in March, that there are a lot of vault infrastructure platforms. There are a lot of funds wanting to come on chain, but the things that connect them, so vault curators, people that are DeFi native and know how to move these assets and understand them, and can also do the execution for them, which is another important point that I'll touch in a second. There aren't that many, so you cannot really satisfy these two if you don't have more curators. Outside of the big four curators, Mev, Gauntlet, Steakhouse, and RE7, who have been in the game, and also arguably, Seven Seas, who have been in the game. They were already big when curation started being a thing, and they were smart enough to move into it. Outside of them, there were very few smaller curators. So our approach initially was okay. Strategies are becoming more popular. These big guys, they manage a lot of money, and they don't really have a massive diversification in their strategies, which I'm not saying it is a bad thing. If I were to manage how Mev was doing at the beginning of the year, or Gauntlet, 500 million, you don't really need to take risks and create overly complex strategies with assets that are new. But we were new, and we decided to take an asymmetric bet on the type of strategies that we're doing and the infrastructure that we're playing on. And curators do exactly this. Curators are the guys that actually automate these strategies. Ideally, should do the best risk management that they can for each of them, at least for people that are in our vaults and know our stuff. We always publish documentation for our strategies. We have two upcoming strategies that we're going to launch most likely early next week. And there's a 24-page document for both of them, so 12 pages each, explaining all the parameters we have and the rationale behind why we chose a certain health factor. And yeah, you then, if you trust the curator, if you like the strategy, and if you like the offering, you can deploy capital with them. But you need on-chain execution, and not a lot of people can do that. This is something that is a very boring but very real insight into vault curation. Outside of the big four guys, there is us, and I think, but I'm not sure, Alterscope, who actually have in-house devs and can do in-house execution. Meaning we run our own bots. We have our own data clusters where the bots live to be able to actually do the strategy to maintain LTV ratios, delever automatically when stuff needs to happen. The vast majority of other smaller curators, you would be surprised, they completely outsource. They completely outsource their automation. So
Right
this
now,
is
what
how
would
you
you
should
say
look
is
at
the
it.
biggest differentiator between the players on the curation side? Is it, I mean, to from a user's perspective, it seems like most of you guys, like putting you in one pot with
Yeah.
RE7, Gauntlet, MEV, etc., you're all competing over a very similar set of strategies and also over a very similar set of capital. So at the end of the day, is it just kind of a competition similar to these high frequency trading hedge funds who are just like competing against each other over a very similar set of metrics? Or is there a trend where different curators focus on very distinct sets and types of strategies?
Um, so first of all, the space is quite tiny yet compared to other traditional finance verticals. And there's still a lot of money coming in where we don't really have to compete for the same capital in between each other. If anything, curators kind of, we help each other out a lot. We are clients to each other, either on the lend side or the demand side, because there's so much money coming from outside of crypto inside that you don't really need to fight people over it. I give a dumb example. I always give dumb examples, but they work, of how the Portuguese and the Brazilians, when they started colonizing South America, they didn't really care about each other initially. They just went in their own directions, and then after they discovered the entire continent, that's when they started fighting over borders. And we're still far ways away to be a much more sedimented space. As to the diversification of assets, I mean, even between the big guys, you have different. They approach strategies differently. Um, Mev are the closest in how we approach, where they try and diversify as much as possible, and they're not at all scared to do more, to take on risks on more creative strategies. RE7, they're much more institutional in their approach, and they have a lot of capital coming from like off chain and from their own network of hedge funds. So they don't really play uh, they don't really look at the retail side of curation as much as we do, for example, because they just don't need to. Gauntlet are similarly a lot more institutional focused, and they're focused a lot more on borrow lending markets simply because they worked with Aave and Morpho for so long. Steakhouse are morpho native, and only now I think they're gonna go curate on Machina as well. But Tao, we made our name initially, first of all by not going on Morpho or Euler. We didn't want to be after 4 or 5 pages of Gauntlet, Mev RE7 Steakhouse. You kind of see like some guys and on page 5 running a strat with like 800,000 in deposits. We decided to, as I said earlier, go on more markets and on iPort. More markets is growing very nicely, and iPort absolutely exploded in popularity. So that was definitely a great bet. They also took a chance on smaller curators. They had the same idea, and we took a risk on strategies. We started doing leverage looping, and this is where Roger has to receive kudos. Our first strategy was a SRUSD loop. We wanted to do a different loop than the one Reservoir was running themselves. Then we made our first ever bond ETF, and it's still the only Pendle bond ETF product in the market. It's growing nicely and organically to 1 million deposits. There's no really hypothecation in it. Exactly. And we focused on loops, we focused on bond ETFs. And as of next week, we're going to have two carry trades be out. They are at the surface level a bit similar to Reservoir's BTC and ETH yield, but we have different leverage, we have different risk parameters, and we have a different way to manage the risk there and maintain the yield. Infinify also gives yield differently from Reservoir. Oh, and the trade part of the carry trade, we do it in SIUSD. We modeled it out, and it looks really, really attractive. Another differentiator for it, for example, is on ETH, we used wrapped stake ETH as a deposit token. So you get a 2.6% extra on whatever yield we generate that we never take a performance fee on. That is another very good selling point. This is how you differentiate. Yeah, this is how you differentiate curators. We've made a bet on being asymmetric. We've made a bet on making slightly more exotic strategies, taking on a bit more risk because we're smaller and we had to grow. But now we are slowly, as we grow, we're slowly also moving into making more standard products. We are running a lending optimizer for a Swiss hedge fund. We are making another iteration of it for them as well. And we're building a lot of other custom vaults for funds.
So just to summarize the differentiation in the types of strategies. So if you look at RE7 or Gauntlet, they're mostly focused on, let's say, rebalancing, lending aggregation. So just stuff that is simpler to understand, also more attractive for large capital because
Yeah,
these, I mean, the lending side will not flip negative against you, whereas a loop can quickly,
yeah,
that can quickly happen. And you're more on the DeFi native boutique and like Protail user side, right?
exactly.
Yeah.
Exactly. And as we grow, we are kind of converging in the same areas. I see Tao a year from now doing the same set of strategy as all of the big curators, simply because we will manage, if all things goes well, we will manage a lot more money. So we won't need to take as many risks to make a name for ourselves. People already know us a lot more than they did 6 months ago. So yeah, that's
No, that
encouraging.
makes sense. Maybe in terms of the capital that is currently being competed over, but also the capital that is flowing in. Do you have any insights? Who are the large players who are adding capital to DeFi and the Vault ecosystem right now? Is it mostly crypto OGs? Is it TradFi hedge funds or TradFi family offices? Like, who are these institutions that have finally arrived in the space?
I don't have numbers on hand, but a significant portion of it is actually retail, especially smart people like you have in the dojo. The thing with institutional, so I talk to hedge funds almost every day. Even the most and even hedge funds that are a bit more young and like, okay, let's actually start doing these, they still move very slow.
Hmm.
And this is global. This is with hedge funds from the US, from Switzerland, from the UK, from Hong Kong. They're all they don't deploy as fast as you think. It takes a long time to for them to deploy in a vault. They have very different risk parameters. So a lot of these strategies that become very popular overnight, a significant chunk of capital actually is and when I say retail, I don't mean people that put 3K in. Like we see in our vaults, there are deposits sometimes of like $300,000 all at once. So they're obviously whales. But when I say retail, that's what I mean mostly. I mean people that are in the space and maybe a couple of guys that manage a couple of million. Institutions are great, but everybody's trying to pander to them. Everybody's trying to pander to them. Whereas we took again a bit more of an asymmetric bet on retail, and that's how we managed to get a lot of our capital in. We only recently started signing big LPs and big funds, so the vast majority of our capital, I think over 90%, is retail. People from the dojo, people that we know in real life, people that we interact with, people from other projects that we know, small parts of their treasuries. So a lot of retail.
Yeah, I noticed the kind of catering to and sometimes even like sucking up to institutions because I noticed that during DAS London 2 weeks
Yeah.
ago. It's I mean basically, especially in Europe, you have all of these legacy money, old money type family offices and larger funds and private banks that are often very intertwined with these family offices. And these are huge amounts of capital. So if you are the one who's able to unlock even a few percent of that to flow into DeFi, I mean, every curator is going to bow down because you'll make up a huge chunk of their AUM from the
Yes,
get-go.
we are having very active conversations with a bunch of funds. Two of them in particular are very, very big. And we're discussing exactly this for them to act as LPs. We build and execute on chain strategies for them. We start with smaller amounts of capital, and then they slowly get more comfortable and then they get in. We've also built our tech stack for strategies is also quite impressive. We have our own data cluster for our bots. We have our own way to interact with them. We can create multi-sigs for them and give like 3 out of 5 to a fund, and we keep the rest. I'm sorry, create a 3 out of 5 signature. 2 signatures goes to a fund and one to us whenever the automation needs to execute or to rebalance. So it's really exciting stuff. It's really exciting stuff, but they just move slow. So whenever you see a lot of
Yeah.
capital moving in all at once, just so you know, a lot of it is retail. Also, can you do something for me, please? Can you go on the APY tab and can you press that instead of the TVM?
Sure.
Because and you can scroll the top five, you see all of our strategies are in the top five, and they always have been. Almost always, you have our strategies in the top. We consistently outperform most strategies that are equivalent there
Nice.
in
Is there
style.
any, maybe do you want to briefly explain how the Infinify Points Max or the Yield Bond ETF work?
Sure. So the Tau Yield Bond ETF is my favorite vault. I know it's not something you should say. Um, who's your favorite child? This vault is extremely simple. Um, Once every couple of weeks, we select a series of PTs. We look for them to have deep enough liquidity and for their performance to be attractive enough. And we simply create a basket, as you can see when you scroll, of these assets. The core idea of this one is we made it for like treasuries in mind. And you have some capital, you want to allocate into some assets, but you don't want to worry about the market being too volatile. Now, the disadvantage with being in PTs is that when the market is doing very well, okay, you might see a slight bump in PTs, but mostly you will miss out on a certain percentage of growth that you will have had, that you would have had if you were in a different strategy, in a leverage loop or in a leverage long. However, when the market tanks like it did on 1010, boy oh boy is it nice to have locked in rates. We saw quite a bit of inflows. I'm
Hmm.
surprised it's not higher TVL, but people really are degenerate, and so are hedge funds. And I'll be honest. Whenever we presented the bond ETF to bigger hedge funds, we were expecting raving reactions like, "Oh my God, you guys created this, so you're the only ones that have them. We will deposit 10 million right now." But then when we talked to them about the reservoir points max or the Infinify points max, they were a lot more interested there. Even though it's much higher risk, it's leverage, there are points involved. And so, yeah, honestly, in some ways, the emperor has no clothes when it comes to institutions. A lot of them just want to make like the highest return. But kudos to the bond ETF. It grew from like 400,000 deposits to like 1 point something million purely organically since 1010. And yeah, it's great. We always rebalance it. We always add and remove assets from it. Whenever we see something bad happen to one of the underlying assets, we just remove out of it, etc. The Tau Infinify Points Max and the Tau Reservoir Points Max, this is how we made a name for ourselves. They are the same logic. This one loops SIUSD to USDC. We are a day after the market moves and the capital moves that made borrow rate spikes and yields fall for a lot of yield-bearing stable coins yesterday due to the gray box FUD that we're going to discuss, as you said. The performance on this has been very, very consistent. It's been slightly negative for 1 day. IPOR now shows the average 1 day performance. So this is
Hmm.
trailing by 1 day. In a couple of hours, it should be up to zero and then just keep going positive. And outside of this, we run a couple of private vaults for some funds. However, and I'll talk about it more at the end in detail. Next week, we are going to be launching a carry trade, which is deposit wrapped Bitcoin and deposit wrapped staked ETH. And we carry the loan on the other end on the second leg. And the second leg is effectively the Infinify loop strategy, which should generate very attractive yield on wrapped Bitcoin and wrapped staked ETH.
Very nice. Talking about the little crypto Twitter drama of yesterday around a few
And
of these gray box, let's say, vol strategies. How did you perceive yesterday? Who do you think the main actors are, and what are their incentives to act the way they did?
So, first of all, I am not in the business of calling out either competitors or projects that we know. It's not my business to say who does right or wrong. I will not name any names. I don't think it's my place to do so. That being said, this is something that we've discussed about at Tau with Roger, with Kepler, and the rest of the team for like many months now. TVL, is it a vanity metric or not? The problem is that it is very easy to take some deposits, loop them several times, tokenize that rehypothecation somewhere, take that tokenized rehypothecation, borrow against it, and rehypothecate that again. So if I take the example, Tau, it's very simple for us. Like I said, we're around 9 million deposits, 70 million TVL notional, and we always announce notional whenever we publish these numbers. I can tokenize our fund, and suddenly I have tokenized a $70 million fund. You have to look in the fine print to see its TVL, yada yada. I take that to Morpho or Euler or some other place. I can borrow against it, and then I can loop that up.
Hmm.
I loop that up 5 times. Suddenly, I'm a $350 million fund with only $9 million in deposits. We all decided against doing this, but I will be brutally honest. It's been uh, the temptation was there because we were like, everybody else that is our size is doing it, and we don't do this out of a sense of I don't know, misplaced honor, whatever you want. We don't want to feel nasty about it. Turns out it was the right decision, but it has been tempting to do the same thing that many other people are doing in this space: double count our own TVL from one platform to the other, rehypothecate that again, And yeah, they'll come and say everywhere that, hey, look, Tau Labs, we are a $500 million fund. Look, we're so massive. It's not just the guys that are being talked about now. So it's not just Stream and the Midas stuff. There are a lot of vault infra providers that have in-house curators, and they're the same entity, and a lot of them double count their stuff. So you have this much capital being live on the platform that is all curated by this actor, and because they loan to each other, sorry, because they lend to each other, it's double counted,
Mhm.
and suddenly you have these funds and these vault infra providers that are the same entity that come out and like in a couple of months they say their TVL is 500 million when it's you actually look at the wallets and you see no, it's like 60, 80, etc. One good example here actually, and this is a positive example. Dialectic have been in this space for quite a while, and Dialectic actually do manage like at the very least $100 million, and they've been consistently doing so for years. So they are an example of they're actually true with their AUM whenever they announce it. But yeah, I see. I only want to call out examples when they are
Uh,
positive. It's not
No,
my
I
role.
like the dialectic guys. We met during DAS London, and personally
Yeah,
very excited for the
yeah, that's
Machina
quite right.
infrastructure, especially once it becomes a little less permissioned and we can all spin up our own vaults and compete against each other. But yeah. So just to get the mechanism behind that straight. So what these gray box vaults were doing, basically, if I understand it correctly, let's say you have 10 million in deposits in your Tau vault, and now they went and tokenized it into a Tau USD receipt token. And with that Tau USD receipt token, they would have gone to a lending market like Euler or Morpho, supplied that, and borrowed, let's say, USDC or USDT against it, and then used that borrowed USDC and USDT to further deploy into their yield generation strategies, right?
Yes.
So
Um,
basically, the returns that they were advertising were possible because they had access to more capital than what actually was deposited into the vault, right? Because
uh,
otherwise, if it's like otherwise they would have diluted themselves, no?
that's a very good question, and I don't really have an answer for that. Um, I'll give the counter. And for some of these funds, it's very hard to see what their actual deposits are. Whereas for us, it's very straightforward.
Yeah.
We are in the process of building our own data pipeline to have a dashboard on our website, like how Gauntlet has, and have all our strategies and be transparent with these. But first, it's very simple. We have 9 million deposits. If you go like vast majority of our TVL now is on IPOR, and next to total value managed, you have TVL, and TVL is deposits on IPOR, and the TVL is only the rehypothecation. We don't take that. We don't double count it. We don't take it anywhere. But what these guys were doing and are doing is exactly that. Yes, you rehypothecate your tokenized rehypothecation, and you
Mm.
advertise that as TVL, but you want to strongly imply that it's assets under management when it's
Yeah.
not.
Yeah,
Um,
I find it interesting how TVL is still viewed as such a core metric, even though it has sort of become consensus, at least within the educated circles in DeFi, that
yes.
it is definitely gameable. But like the question to me remains, and I mean, I think stream finance was the most discussed example yesterday. And like I met 0x Law in Singapore during token. I also had him on the pod, and like
At our
I'm
event,
personally,
at the event
yeah,
we co-hosted.
I'm deposited into Stream. I'm very bullish, so I'm like obviously biased here. I respect him a ton, what he's doing, like great on chain farmer. But like to me, the question remains is that the way I've understood Stream in the past is that they rather had to cap their TVL because many of these strategies that they were doing would obviously be much harder to manage if you actually had 500 million to deploy instead of, let's say, 100 million, because a lot of the stuff that you can extract a clear edge and asymmetric returns out in DeFi are capped in terms of capital you can deploy before you start diluting yourself. So I think like what I would like to understand is what is the trade-off between increasing TVL as a vanity metric, maybe in order to raise at a higher valuation or to like seem more impressive in closing partnerships for private deals, etc., versus what disadvantage do you take from that by now diluting yourself on the yield generation side of things? I think that the allegations raised by some other people in the space that like affected, or like they implied that many of these gray box vaults were severely under collateralized. I think that was kind of a misrepresentation. Like just because you rehypothecate doesn't under collateralize you. Like there still is capital that can be unwound, and if it's like unwinding, you are fully collateralized. Of course, there are liquidity constraints. Like something happening like on October 10th, if that was to happen again, and some of these players, like let's say Stream, Elixir was also mentioned in a few of these allegations. I think Avant is another one where it's sort of
Yeah.
gray boxy what they're doing in the back end. Like if these are being hit hard due to some like market price based oracle and like a low health factor on lending markets or whatnot, like that could have severe repercussions, and that could really lead to, I wouldn't say like to it wouldn't be a Luna UST style collapse because it's obviously not algorithmic, but that could lead to a huge singular drawdown triggered by one singular
Yeah.
event. So I do think that it is a good development to have this discussion in the space, also
Abs-
to kind of pressure people. I mean, the people raising allegations. It's sort of from a depositor's perspective, it's game theoretically a positive development because I, as a depositor, when in doubt, I get more transparency from the protocols. I still believe in the underlying protocol and the underlying strategy. So, like with a lot of scared capital exiting, I can buy up stream PTs for 24, 25. I think it briefly spiked to 26% yield on Pendle. So like for me, it's a positive development because my underlying thesis in the protocol has not changed. But yeah, I do think it is a healthy development and like a sign of maturation that
yes.
there is more pressure on these protocols, and that will hopefully prevent us from ever repeating a situation where you had these cataclysmic fallouts. And yeah, that we've seen. I think it was BlockFi. I'm not sure if Nexo was involved during last cycle, but obviously there were a
Regaros,
bunch of
Celsius, Vanguard.
kind of yeah CDFi type
Fi.
protocols and projects that were hit by the UST collapse, and like
Yes.
these other long tail events in
Look,
DeFi.
the solution to this, as far as I'm concerned, is very straightforward. It's the EOA part. Oh, so first of all, I also know 0xPxls, great guy, super smart. I'm not gonna talk anything negative about him about Stream because we don't have that culture at Tau, and I don't want to encourage it. Um, we are of the opinion that if you run an EOA, you run a private strategy for a client that is permissioned, and for that you should have very clear mandate. Literally, what hedge funds do, it should be regulated. All of our strats are permissionless. You can verify all of them. They all have addresses you slam into DBank. They're all fully documented. It's this removes these scares. This removes these issues. But like, where's the yield coming from? For us, it's extremely extremely transparent. If everybody did just that on the permissionless side, these discussions wouldn't exist. Now, I know Stream are also dabbling in market making, in arbitraging stuff between centralized exchanges. So they actually do need to, run an EOA and take funds and move them there because of the KYC stuff. But we are of the opinion that there is so much unused potential in DeFi and strategies with assets that are permissionless and that are out there that we don't really need to go. Tau doesn't really need to go and run EOAs and go on Bybit and run strategies there. Look, transparency should be the standard, and we have blockchain for that. So the solution in my mind is very simple. If you want to take the risk of trusting somebody, then go ahead. It's your capital. Uh, how we are approaching our stuff is that you shouldn't trust us. You should just look at the math for all of our strats. If it's for you, great. If it's not for you, it's fine. Look at other strategies. A bunch of smart people are building very cool stuff in this space. It is hurtful for the space. It is hurtful for the environment to run these because how did how did the contagion happen when Terra collapsed, right? Like everything was a Ponzi scheme within several Ponzi schemes, and Terra was holding everything up. And when Terra collapsed, everybody realized that, 3 Arrows, Celsius, Vanguard, all of these guys, BlockFi, they were all on paper they were funds, but in reality they were banks. They were acting like banks, and they were borrowing and lending to and from each other based on order books, based on internal accounting order books. You had no way to look and see how many assets they actually have, how much is rehypothecated, what's the health factor for each of them. Today we do. Today we have. And that's why they collapsed so horribly, and they fell one after the other until FTX collapsed, and then we started a year and a half long bear market. It's much harder to happen now because a lot of the space is still a lot more open. But we saw even yesterday with Stream, Reservoir, and others moving assets, how borrow rates spiked and how it affected yield across all yield bearing stablecoins. So you can still hurt the market a bit. It's great to lend in that market. It's great to run lending optimizers. We saw performance even double in
Yeah.
one of them yesterday. But I think transparency is the most important thing, and we actually have the technology to make trust irrelevant and just be able to verify strategies. And I also want to say one more thing: if ever, and I'm not virtue signaling, I'm actually being legitimate. If ever one of the strategies we run or one of the risk parameters that we publish are too obtuse or not transparent enough, please always feel free, anybody, to DM me on Telegram, on Twitter, on Discord, and signal that to me. We want to
Nice.
just run open strategies and grow from there on legit merit
Yeah, I
and
think
strength.
there's a lot of catching up to be done on the transparency side of things, especially with the vault space maturing. I think it's also interesting to see that now you have these different vault curators shifting their funds, but it spikes interest rate that much across markets. It is a clear indicator that a lot of the DeFi TVL is now being managed by these funds, and that they are market participants to be taken very seriously, which I kind of prefer to the Justin Suns of the world, who single-handedly can like spike or crash interests and borrow rates of single assets. Because I would say that these funds and vaults, after all, still have a little more prudence and a little more, let's say, consideration before we take action. But yeah, unfortunately, we only have a few minutes left. So you mentioned that there is a new vault you're about to launch, incorporating a basis trade, or two new vaults. So do you want to cover them?
Yeah, as mentioned mentioned previously, most likely we will launch it at the beginning of next week. Uh, the devs at Tau, they do have a de facto veto on when we launch stuff. Um, we test stuff a lot more than we should, to be honest, but it's all for the better. Two new carry trades: deposit wrap Bitcoin, deposit wrap stake ETH. The deposit is then collateralized. We take USDC against it. We manage this loan. This is the first leg of the carry, and then we move the trade over to the Infinify SIUSD USDC loop. We modeled it for a 5.7% borrow rate. At the time when we modeled this, the borrow rate on SIUSD was 5.5. I think it's 5.7 now. And for a 8.5% yield on SIUSD. Right now, that is, I think, close to 7, and it's only going to slowly go back up to the level that Infinify holds it. What yield that would give is around 11.3% on Bitcoin. Now, I think it's going to be a bit lower. If we were to launch it today, it will be closer to 5, but again, with yield on SIUSD growing. And a bit more on ETH. I think around the 11.5, 12% point, plus the 2.6% you get from wrapped stake ETH being the deposit token. Next to this, you get Infinify points and you get Fusion points. We had our very own 0x Roger that did some napkin math. You will be able to read it in the long prospectus we prepared for the strategy, which we will make public, and you'll be able to read it everywhere to see all the parameters that we chose. and make your idea if the strat is right for you or not. It is a bit on the higher risk because it's a carry trade where we have to manage a debt against Bitcoin and against ETH, which are volatile assets and they move. But we already have liquidity buffers built in and scenarios for the bot to delever whenever whenever the situation calls for it. If the asset price falls very sharply, we modeled it for a drawdown as bad as October 10 plus another 20% margin for us to be able to pay at least that at least once and then start rescaling back into the position.
Nice. So these are going to be live on Monday, right?
Monday or Tuesday. Again, the devs are the actual bosses at Tau. I just talk to people, and Roger and Kepler, they do the actual work and the actual math, and the devs, they do the actual work to implement it. And I'm just a cheerleader at this point, so it's whenever they say. Most likely, it's going to be Monday or Tuesday, I think.
Nice. So yeah, get some capital ready, I guess. Because we all know that many of the Tau Labs vaults are capped, and they quickly reach their caps, especially the Infinify points max one. Fortunately, a few days ago there was a nice opportunity to get in again when some people exited in the crash aftermath.
Yes.
But yeah, was amazing having you on, Vlad. Where can people find you? Where can people find Tau? And how can they contact you if they want to reach out?
So I am very open. Unfortunately, I still have there's still a Calendly link on the website 628labs.xyz where you will talk directly to me. I will have to take it out because people started in the past month to just book nonstop, and I constantly talk to people that I have no idea who they are. So take advantage of that if in the next couple of weeks before I get tired and I just remove it. At 0xPxls on Twitter. I don't have a lot of followers. I'm not very active there. At Pixel2904 on Telegram. I'm mostly active on Telegram. And the Telegram for Tau Labs is at 628 Labs. Tau, and this is a little thing with the name. Tau is the actual number. Tau is 2 times pi. Pi is 3.14. 2 times 3.14 is 6.28. That's why you see our branding, a lot of it be interchangeable, Tau and 628, because it's the same thing. And the logo itself is a 6, a 2, and an 8 all smashed together. So you will find us up under these names everywhere on our socials. We do not have a Discord yet, but as we grow and as we get a lot more, as we get our own community, we will also have one whenever the time is right.
Very
Thank
nice.
you for having me on, Max. It was
It was an absolute pleasure, and yeah, lots of very clear cut, straight through the noise opinions. I appreciate it a lot, and I'll make sure to put all the links in the description, and yeah, hopefully have you back on the pod soon again.
Anytime.
Have a good one.